From the morning reading, the Bulls in love with new closing highs on Valentine's Day. The Bears are pierced with arrow. Financials lead once again. Breadth weakened compared to the prior session as advancers led 1574 to 1424 on the New York Stock Exchange and led 1567 to 1228 on the Nasdaq. In other news, the one-year anniversary of a large, calm rally. The just past one-year anniversary of the rally shows that the S&P gained more than 25%, the Nasdaq more than 35%, with both enjoying extremely small standard deviation of daily price changes. In the history of these indices, other times they passed the one-year mark of large, calm rallies led to generally poor returns in the medium term, but better long-term ones in the case of the S&P. The Nasdaq run has been impressive. It has gained 8 out of 10 days, with 2 losses being extremely small, all culminating in a multi-year high. Prior to the last 30 years, that kind of momentum led to good returns. Since then, all but one occurrence had led to negative returns over the next 1, 3, or 6 months. Fed Chair Yellen gives testimony to the House on Wednesday. We've highlighted these testimonies in past years, showing how they tend to coincide with inflection points in stocks when they've been near a high or low. Bond yields clear the 50-day line on Yellen's testimony. That helps financials and hurts utilities. Financials utilities ratio turns back up. Rising yields boost the dollar, and that hurts gold. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:09 a.m. Mountain Time, and I am recording this in preparation for the market day of February the 15th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce into the morning report. And things fairly quiet this morning. A bit mixed, nothing really of significance to either side. You have the S&P and Nasdaq futures down just below scratch. Russell futures are down about 0.25%, and the Dow futures are up just above scratch. Crude oil's down about 0.2%. Euro's down just below scratch, as is the long bond. Gold is up just above scratch. And overseas action, it's mixed. China is currently just below scratch. Hong Kong is doing well with its market being up about 1.2%, and Japan up about 1%. Germany up just above scratch, and United Kingdom up about 0.5%. And macroeconomic reports for today for the United States of note, you have CPI, core retail sales, Empire manufacturing, capacity utilization rate, and industrial production. Following all that up, we all have Fed Chair Yellen speaking. You also have the weekly crude oil inventory and FOMC member Harker speaking later today. And looking forward to tomorrow, you have building permits, Philly Fed manufacturing, the weekly unemployment claims, and housing starts, along with mortgage delinquencies data. There'll also be the natural gas report. So quite a bit on the macroeconomic schedule for today and tomorrow. It should give us some pretty sharp insights as to what's going on with the U.S. economy. In terms of the current volatility conditions, short-term VIX, look at this, 8.94. Wow, I can't remember ever seeing an 8 on that number. So clearly very, very, very low volatility. In fact, almost historic. It really is dramatically low by any metric. Skew is in the second level of caution at a 133.66. So this certainly is pointing to the kinds of things that start to happen when you have low volatility and the expectation of expanding volatility. The big question, of course, is always when. IV percentiles also exceptionally low, especially on the S&P and NASDAQ. The S&P coming in at a 5. The NASDAQ is at a 0, so volatility in the NASDAQ has not been any lower in the last 52 weeks than it was yesterday. The Russell's at a 14, the Dow at an 18. We did have standard deviation size moves put in on 2 markets yesterday. The S&P and the Dow were both up by more than 1 standard deviation size move. And if you take a look at this, 3 out of the last 4 sessions on both of those markets have been positive days. So this has been a very strong breakout with strong confirmation on both of those markets. In terms of the current charts, let's go ahead and bounce over there. And you see this on the S&P futures. Look at this. And not only did you break out of the horizontal and break out of the diagonal resistance areas, but you did it with force. And we've got 4 very solid bullish candles in a row, each one of them being new all-time highs. And this angle here is actually, very impressive. This is not an individual company. This is an index. And for an index like the S&P to have a breakout like this is truly exceptionally strong bull. Now, this is unsustainable. At some point, we're going to see some sort of consolidation. And indeed, the overall move ever since the election is going to need to see some sort of consolidation and correction. The market has to exhale. Now, the market can exhale by one of 2 different methods. One, by time. And you could argue that we did get that right here, that we had weeks of sideways movement before the most recent action, and that is the exhale, and that we should not expect anything more than that. Then there is also the correction by price, and while that's always a possibility, given especially these very impressive large bullish moves, these kinds of strong bull moves are generally expected not to have excessive corrections. So indeed, many times those corrections are seen as buying opportunities where people, the value people out there, look to snatch up something at a lower price than what they have been doing on the breakout. So there's a couple things going on here. Frankly, right now, it's very hard to see anything that is, terribly promising for a bear out there. This looks to be an extremely strong bullish market, and one in which the bears are the ones that frankly get run over more often than not. That's just probabilities, but that's the way it looks. This same thing here in the Dow, very impressive, very bullish breakout. Each candle, new all-time highs, and the intraday overnight action even pressing forward with that. In terms of the NASDAQ, if the NASDAQ didn't have already a strong enough bullish resistance area, it has penetrated up through that, and the angle has become even sharper. Now, this is probably the best example of the 4 indices in terms of buying exhaustion, and you get these parabolic type moves. Often what happens is that you get a fairly sharp correction to come back and give some of that back before resuming the bullish move. So buying in at these levels becomes increasingly difficult, and one in which if you're not already participating in this, you might want to do it in incremental fashion, because buying in at these levels is certainly extremely challenging. That being said, there's reason for all this. This is all started, this is the election night, and all this action has come since the election. There's huge expectations for reforms and corporate tax rates, for reforms and healthcare, which is an enormous expense for business, both large and small. And this is being priced into the market, and this is a change from where we were before this day. So business is responding to these expectations. Now, these expectations may be fully fulfilled, or they may be partially fulfilled, or there may be disappointments. We'll see where this goes as we go through the ugly process of making the sausage and creating new policy and so forth. At the same time, as traders, we have to respect what is the market telling us, what is the chart telling us, and this is about as close to parabolic as you can get for an index. So we've got to be careful with our actions in these areas. Perhaps spend some of that money that you're making in profits on protective puts to lock in some of those profits that you're accruing. Those puts are extremely inexpensive at this point with volatility as low as it is. And the Russell is the one that's been, the most challenged of late. It's the one that had the biggest move in the post-election period. But then once it went into the sideways consolidation, like the others, it's been more locked into that sideways consolidation than the others. Now, in recent action, we have probed the top of that horizontal resistance. And you see, this right here was probably right at a all-time closing high. This one was certainly a new closing high with a new intraday high. Much more of an impressive all-time closing high. And so it's a bit more incremental here, but certainly the Russell is pushing and the bulls are pushing out into these new areas, and I'm not sure I would call this a full-out breakout yet, certainly not in the context of the other three relative strength of the other three indices. But certainly the Russell is participating, and there's nothing to say that the bears have a lot to look for other than, the promise of exhaustion giving an opportunity. But our expectation of that would be that would probably be a buying opportunity given probabilities of these kinds of patterns. In other markets, crude oil is still in a sideways market, though hugged on the bottom side very closely with both diagonal and horizontal support, also represented by the cloud here and key moving average lines. But at the same time, the bulls certainly haven't been able to get anywhere. We haven't been able to get up above about 54.30 and hold that for quite some time. And there's been a lot of touches of that area. So frankly, remember that resistance is expected to hold until it doesn't. And, if you had taken that approach in the last 2 months, you would have been correct about 12 times versus the one time that it ran over that area before reversing and closing back well down into the range. So even that occasion, you would have been right if you'd had a large enough stop to be able to stand it. So crude oil very much locked into sideways consolidation pattern. Gold, which has not been locked in a sideways consolidation pattern, perhaps one of the stronger trending markets in the last 2-month time frame, has in the last few days gone into something of a sideways pattern right here at the top of the cloud. Now, much of this has been part of the dollar situation, and we had one of the morning authors mention about how the rising yields are boosting the dollar, and that in turn hurts gold. And you see the dollar has been coming up. It's still in this overall neutral market posture, being inside this large cloud formation. But that being said, it clearly is rising, and certainly could come up here to challenge the former all-time, I say the former, not all-time highs, but former highs, something about 14-year highs in the dollar. So kind of keep that in mind. And let's see here. Let's take a look at bonds. Bonds also a bit more of a complex sideways consolidation. Not as clearly sideways as the crude oil market is, but still one in which the general expectation and probabilities is that this would break down, especially in the face of the Yellen discussion of multiple, perhaps even 4 interest rate hikes for the year. So that's not, super friendly for the long bond. So, the expectation is that this pattern will probably resolve to the downside. And then finally, let's take a look at the VIX. Wow. Just we talked about the short-term VIX. The regular VIX, 10.69 on yesterday's close, exceptionally low. These are great places to be buying some long to intermediate term protection as part of your hedge portfolio strategies. So be considering that. Just one thing about that. Whatever your strategies are to the intermediate or long-term hedging, make sure you buy enough time and that you handle that in the proper way. So bottom line to all this is, as we look at the indices, is short-term indicators are suggesting a buying exhaustion is lining up. At the same time, intermediate-term indicators are looking quite bullish, which suggests that this rising trend should continue despite some short-term pullbacks or a correction. Okay, that should be enough on the charts. Let's go ahead and go to the daily report, and this continues to strengthen. Overall, our intermediate term phase opinion, market phase 4, these are one marked by extension patterns, and certainly that has been the case the last 4 sessions. And in terms of the 3 buying market timing signals, the first one coming to us from Investors Business Daily, IBED, confirmed uptrend, that's bullish. GMI Index, perfect 6 out of 6 with a buy signal in place since 11:10, that's bullish. And the stock charts decision point scoreboard status, very strongly bullish in the short term and the intermediate term. So we're getting close to that long aspired stack that we've talked about for months, where all these line up across all the different markets and across all the different time frames. We still have some signals in the long term that are conflicted, so we're not quite there yet, but certainly this is about the best looking set of market timing indicators that we have had in a very long time. Now, that doesn't mean that everything is easy. We are likely to have some of these exhaustion pullbacks and so forth along the way, so just be prepared for that. In terms of the position sizing models, both models coming in at 100%. Intermediate term market postures, exceptionally strong bull. I mean, look at this. We're almost about as high as you can get. The S&P about a 96, the Dow a 93, the NASDAQ a 98. So, if anything, kind of hitting their heads up against the top of that indicator. Russell has surged forward in a very impressive way in recent sessions and is just a notch below going to exceptionally strong bull itself. And this is all supported by a strong bull sentiment line, so everything is very much in the bull camp on that side. Hedge warning status remains 0+, normal with some elevated conditions. And the only really thing that's holding this thing down from going to level 0, which is full normal bull market, is these mixed signals on the long term of the decision point scoreboard. Strategy opinions, no changes from yesterday. We're still warning against the very low VIX, providing very low premiums for the amount of risk, and that could be something of a difficult proposition for novice traders to handle. And then also in terms of cover calls, it's difficult to enter brand new positions in any kind of significant size when you're this extended in these indeed extension patterns. So frankly, we talked about the NASDAQ and even the S&P and Dow, looking like they could potentially be in kind of almost parabolic type of positions, mostly talking about the NASDAQ with that comment. In terms of specific areas of warning under the volatility bucket, most of these are related to expectations of some future expansion in volatility. Distribution day count at the NASDAQ just barely into the warning area at a 5. Under the trend-based area, everything is extremely strong. And under the key intermarket risk aversion indicators, everything now on the risk-on kind of posture. Sentiment, a bit extreme. Stocks intermediate term is at an 8. And the fear and greed index has gone into extreme greed at this point. So anything above a 75 is getting extreme. And indeed, we start popping, we're not far from an 80. And this rarely gets to a 90 before you see some sort of pullback into the market. So starting to get into that category where we start to watch for those signs of reversals, watch those candlesticks on the daily chart and so forth for signs of reversal and those opportunities perhaps of pullback. S&P performance overall was strong yesterday, up about 0.44%. Once again, financials leading the way, not just as a percent, but look at the breadth here. Just a handful of companies that were not positive coming out of that sector yesterday. And I believe I saw a report, Goldman Sachs, once again an all-time high. And for the first time in the case of Goldman Sachs since before the financial crisis. So a huge comeback from a company that, got severely whacked in the financial crisis era. Healthcare also had a big day. Obviously, healthcare is big time in the news right now and is subject to a certain amount of volatility. Consumer discretionary, information tech, energy, all these risk-on sectors doing well yesterday, and kind of a typical risk-on day as you would expect when you have a new all-time high. The defensive sectors, while some were positive, they were mildly positive, and some were somewhat negative. Obviously, we had that news with the yields and so forth, and then, of course, hurt utilities, and you see this sector was in last place yesterday. In other news, market postures are starting to heal. Other than telecom and retail, just about everything is in up across all three time frames. So market postures are starting to look very strong. Also, percent change across all the different time frames. Other than energy, telecom continues to be persistently one of the most consistent downward sectors. Of course, real estate, it's also interest rate sensitive. Utilities, interest rate sensitive. So you're seeing that show in these two sectors down here. So that should be enough for today. Let's go ahead and wrap this thing up. And you saw these slides earlier during the morning reading. And then these slides here about opportunities. If you need more time to review these slides, just hit the pause button. Also note that if you go to these hyperlinks, you can get greater details, membership information, free trials. And then, of course, there are always the disclaimers. Hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. And we'll see you back here for our next market preview from Falcon Global with tomorrow's session. In the meantime, manage that risk profile and everything should fall into place for you. Good trading.